So first of all, everybody, thanks for joining us. We do these Twitter Spaces typically the last Wednesday of every month. So appreciate everybody tuning in and plenty to talk about today. So we're looking forward to diving in with everybody. My name is Danny Condon. I am the Chief Revenue Officer at Blockwear Solutions. We've got a lineup today of we're going to cover a number of different topics. So I'll kind of hit the agenda and the speakers in one swoop here. So we're going to start off and just talk about the macro landscape. That's going to be led by Warren Rogers. Warren is Blockware's Chief Financial Officer. We're kind of seeing, almost everything is dovetailing from a macro perspective. So I think that's going to really set the tone for a lot of the subsequent topics. So after that, we're going to move into, we're bringing equities back into the picture here, and primarily Bitcoin exposed equities with Blake Davis. Blake is an equities analyst at Blockware Solutions working on the Blockwear intelligence team. For those of you who subscribe to our newsletter, Blake writes that portion of the weekly newsletter. From there, we'll get into just the Bitcoin-centric market more specifically, and Will Clemente, lead insight analyst at Blockwear Solution, is going to be covering that section. And then we're going to kind of conclude with a little bit of an overview on what we're seeing from a mining perspective. And Tanner Davis, account executive at Blockwear, is going to be covering that section. So we'll keep this pretty open. We'll keep this fluid. There's plenty to talk about. We'll run this for probably 30, 45 minutes. And we're excited. So right before we kick it off, for those of you who aren't aware, super high level overview on who we are, Blockwear Solutions. So we're a leader in primary business model is vertically integrated Bitcoin mining, meaning that we sell Bitcoin mining hardware to investors, both institutional and individual investors. And then we own and operate data centers where we provide co-location hosting services. We manage a pool. We provide miner management software. So really just turnkey investment for individuals and institutions looking to make investments into Bitcoin mining. We also have a media and research arm, Blockwear Intelligence. Will really leads that crew as a lead insights analyst. And we also have a staking business. So, we always get a lot of, interest and follow-up from these discussions. So if anybody's looking to learn more or, do business together, we'd be certainly happy to chat. But we're not here to talk about us. We're here to talk about what's going on. So, Warren, why don't you kick us off and let's get into the macro landscape. I mean, not much going on, so this will probably be pretty quick.
I was thinking back, we've done this for 6 months, or I've done this with you guys for 6 months. And, the most remarkable thing about this is every single time I speak about inflation, and I get it that that's not a very exciting thing to talk about, but, we saw this coming. And, I saw this as a driver of instability in equity markets and instability, in crypto and, generally upsetting the global balances. And, what we've seen even since last time, inflation was printing big time headline numbers, well over 8%, 40-year highs, but the S&P was still up on the year, still doing well, still trending in a, lower left to upper right hand direction. Things have changed markedly in the past month. The macro landscape continues to get extremely complicated, presenting a lot of headwinds to risk assets. Inflation, is my favorite topic to talk about, stemming from the free money, easy policies, after the Great Recession, but then, doubly as terrible with the massive, overwhelming COVID response. It was completely unnecessary, but has, pumped way too much money into the markets, and now we're paying the price for it. Why this matters is that, Bitcoin it's a risk asset right now. Like I've said before, to me, it's a technology, it is a currency, and it's a commodity. But, right now, what you have is this environment is punishing, risk. And the Fed, in order to tame inflation, has said today in the release of the Fed minutes that they're looking to hike at least 50 basis points in the next 3 meetings, which, we've done and have done successfully. We'll have, rates, well above, 2%, into the fall. Well, what that means is that, the whole world runs on the price of money, and the price of money is going up, at the same time, the price of commodities is going up, which creates a difficult situation. From this, what I see is that, there was a huge emphasis on buying yield, buying, ROI, buying junk bonds. Before we really started talking about inflation, baseline, rates on like triple C or junk debt were so close to corporate levels. It was historical measures. That's going to blow out. You're going to see, the typical signs of, pre-recession trading where a lot of these corporates, they can't refinance, the cost of debt goes up significantly, and it puts a lot of strain on the markets. The way I'm looking at this is that, there's no way that we're going to be able to deal with, 15 years of inflationary actions by the government in a 1 year period. That means that things are going to be very volatile, very difficult, and you're going to have to figure out ways to insulate yourself from this. Assuming that we're all, concerned about our futures, concerned about, investing, concerned about savings, it's gonna completely change the way that you're gonna look at like how you accumulate assets and what assets you accumulate. So in an inflationary environment, obviously you guys see that the price of commodities are going through the roof. The war in Ukraine, price of oil went up markedly. The price of grain went up markedly. That was already in the cards. The food basket had been going for a while, but that will continue. How are you going to, so owning assets like this, owning commodities. As we've said before, Bitcoin has lived its entire life in a zero interest rate, low inflation, or to no inflation environment. Right now, it's kind of stuck between stations, right? The way I see it is that we're perfectly engineered to fight inflation, but we're still trapped with the risk basket. And what's going to happen to us, what I think is going to happen here is that it's going to take time to find their feet. But this is where I want to be investing personally, not financial advice, of course. But when I look at this holistically, I think about something with a constrained supply, something that has enhanced network participation, more difficulty to produce this asset, unlike other commodities. It should trend up in this time, but it's going to take some amount of time again, to get this, to get out of our own way, so to speak. And the events that I look forward in the future is that if you see any sign of equity stability, Bitcoin will probably trade better. If you see any sign of rate stability, Bitcoin will probably trade better. But it's still going to be very confusing, very complex, and additional macro factors compounding this. Look, China has not bounced back, right? I mean, you see, the world's manufacturer is still, in one way or another, going through a series of lockdowns. That hurts global supply chains. It pushes up prices. Until we see a lot of these parties back on, while then fighting the tide of a pending recession, it's going to be very complex. In this environment, I would still stay close to Bitcoin. That's it's really where I'm looking right now.
No, that's great.
Sure. One thing I've been just thinking about from a very high level, and I mean, this is just a thesis. I don't necessarily have a certain time frame on this playing out, but I mean, the correlation, for example, like we put in the newsletter last Friday, the 3-day correlation had reached an all-time high for BTC and the NASDAQ. When you kind of think about what it's going to take for that correlation to break, I mean, I almost feel like you're going to need some type of supply concentration back into people who, I mean, obviously from first principles don't care about the current macro environment. So, I mean, that seems like it's a process that could take time for that supply to kind of transfer from individuals who do care to don't care. But I mean, aside from just like that, from very first principles, like what kind of market dynamics do you think are going to have to play out to see some type of decorrelation, or do you think we're just at the hip of equities moving forward as Bitcoin is now looked at as a macro asset paired with other things?
No, I mean that's an excellent question. I mean, really well thought through. I think about this all the time. It really causes me a lot of kind of thought loss on this. And the way that I'm looking at it right now, at least today, is that you have this situation where there was a mad rush into crypto in general, right? Last year, right, Will? It was like there's going to be this ETF, there's institutional adoption, there's all this stuff, prices roofed, 70,000 Bitcoin, right? Well, the way I look
But
at it is
to be
like,
fair, it was 69,420.
yeah, you got it, man. I like round numbers. They make me feel good. But the thing is, um, theoretically, that money should like this a lot more. There's a long-term thesis. Real money players, play on long-term thematics, long-term fundamentals, and this is a good market. What I think has to happen, though, is look, every single investor has got some equity exposure, and I think they're just fighting a lot of different battles. So I think we actually need to just go into a period of relative quiet, and then just we'll start to see some positive price performance. But I think like you're gonna start to see some like relative performance indicators that show us that there is a bigger participant in the market. And it's I think right now it's just kind of burdened by headlines, if that makes sense.
Yeah, that makes a lot of sense. I guess the Luna debacle has also kind of probably turned some people off in the short term, at least.
Yeah, right. Yeah, I mean that didn't do us any favors.
So Warren, you hit on a few things, and I want to get kind of Blake's perspective. I think we're going to probably bounce, in and out of macro basically throughout. But as you talk about Bitcoin effectively trading as a risk asset, Blake covering equities, right? I mean, we know what's going on in the equities market. Enlighten us, right? Of course, further, but with maybe a heightened focus on like Bitcoin exposed equities. I think this is all going to play out in an interesting narrative because as you think about this, to kind of foreshadow, at least where my mind is right now, I mean, everything's moving from macro, and then you're seeing equities, right, be impacted, and then you have Bitcoin exposed equities, and then you have, what's going on in the Bitcoin, kind of landscape or Bitcoin centric market, if you will, and then what's going on in mining. That's kind of like a super top down, little decision tree, if you will. So, Blake, I would love to, kind of move to you real quick and just let's see what you're seeing from an equities perspective, and specifically, Bitcoin exposed equities.
Yeah. So, I mean, I kind of want to just piggyback off of Warren because, things are obviously very macro driven right now. But I think like the name of the game for equities in this environment is just, that age old quote, don't fight the Fed. I mean, it's no secret that rates are going higher. The question is just, how long is it going to take for the market to price that information in? I mean, Powell's said repeatedly that, keeping inflation under control is their priority. So, that era of the, Fed put, I think is over, and the market's reflecting that. And if you don't know, it's, the Fed would just always swoop in, loosen monetary policy in order to save the stock market. But with CPI above 8%, you can't really do that. It's hard to say. There isn't too much to say about stocks. I think obviously if you're a trader, it's a tough time to be trying to go long positions. The market's in this stage 4 downtrend for the last 5 months. That's when indexes are below a 30-week simple moving average. It's basically just a signal that the bull cycle's over. And I did a study I posted about yesterday, and I can talk more about it in depth in the newsletter. But I think I looked at every single bear market that the S&P's ever had, and basically what I found is that the index will pretty much always try to rally. On average, there's 2 rally attempts of greater than 10% before we're able to find a bottom. So I just think for investors, it's just being really careful about not jumping in at the first signs of green. Stocks always attempt to rally. You just want to make sure you're not getting stuck if that rally fails. But I think it's really important to be watching the bond market. As we talked about, everything's really macro driven, and the bond market kind of is pulling a lot of those strings. And I know tech investors and crypto guys don't want to hear about bonds and they're boring, but I think it's super important to keep your eye on the fixed income market. I mean, it's the biggest market in the country. It's over $100 trillion. And basically, like, bond yields impact risk preferences for institutions. So even if you think bonds are boring or whatever, they have a huge impact on risk preference, and then that spills into crypto, Bitcoin, and equity prices. And this is kind of because institutions evaluate stocks using bond yields as a discount rate. So changes in bond prices have this indirect impact on stock prices. which I think then spills over into Bitcoin. But if you're interested in learning more about that, you can check out last week's newsletter. I talked a bunch about it. But like one thing specifically I like to look at is this spread between high yield corporate bonds, so basically junk bonds, in comparison to these lower maturity treasury bonds, which are considered riskless because they're issued by the government, and the government doesn't default on their debt. But basically, like, I'm using that spread to gauge sentiment for risk assets from like the smart money, the Wall Street bond traders. And I think, if we see junk bonds, so these bonds with higher default risk, starting to catch a bid, or, that spread falling, I think it could be a signal that institutions are starting to warm back up for risk asset purchases. And, in the last week or so, we've actually seen that spread start to fall, which I think is a bullish signal. But, it's also a secondary indicator for, equity investors. I think price is the only thing that pays. So until stock prices start to reflect that, change in appetite, it really doesn't matter. Like, I hear all this debate about, are we actually in a bear market, which I think is a little ridiculous. But, like, the S&P has been flirting with that, bear market marker of, 20% off its highs. But I think it's more of just like a talking point for journalists and headlines. And, it really doesn't matter, to be honest, right? Like, the end result is the same. Stocks are down. You've seen like most growth or tech stocks are at like 60% off their highs, if not more. Bitcoin is, I don't know, something like 60% off its highs. And, those mining stocks are down way worse. Most of them didn't even recover from that April 2021 top. A lot of the stocks are like 80, 90% off their highs. But I mean, these companies are still bringing on hash, and they still have, fairly bullish earnings estimates for the year. And, with spot Bitcoin price down, that block reward's lower. But, also with, prices down, a lot of the older generation machines are no longer efficient. They go offline, which makes, mining more profitable for these public miners. But Tanner and Danny can talk more about that later. But yeah, I won't dive too much into Bitcoin, but I think might be a good spot for Will to take it over and just talk about what's going on in the Bitcoin landscape, because miners are just so correlated to what's going on over there.
Yeah, for sure. That was a good little segue, Blake. No, that was super insightful. Yeah, I mean, I agree with you. I think, like, kind of high level of kind of what you said towards the middle of that was, like, you don't have to snipe the bottom, right? You can wait for that momentum to come back in as a trader rather than trying to catch a falling knife. And obviously, as you mentioned, price is the ultimate determinant of that. So, no, I think everything you said was like super well received. So,
yeah, you don't have to be first to make a fortune.
There you go. I like that one. I never heard that one before. Cool. Yeah. So I want to kind of pivot a little bit into like the Bitcoin centric stuff. Obviously, not saying anything anyone doesn't know on this call here. Obviously, Bitcoin's been extremely correlated to NASDAQ lately. It's been extremely driven by macroeconomic conditions. So, obviously, want to take some of this Bitcoin centric stuff with a grain of salt. But I do think some of the things that I'm going to talk about are useful for long term Bitcoin bulls, especially as we're approaching some of the things I'm going to talk about. So I think like the way that I've come over the last 2 months over the last 2 years to approach this market has been using this kind of mental framework of value and momentum. And the type of trading that I'm looking to do in this environment is very high time frame, several month type of long trades. I'm not looking to take any like multi-day or intraday type trades. I just don't feel like I have any type of edge in that environment whatsoever. So with that in mind, the type of capital allocation I'm looking to do is from a very high time frame standpoint. So just use that as a preface for everything I'm going to say. So I think when we look at that mental framework of value and momentum, I think first of all, starting with momentum, I see that as getting back above 47,000, which is very far from where we are now. We've talked about this for 6 or 7 months in the newsletter. It's like some of the items that I'm using to describe this momentum threshold. One of the things that we used to get cautious in the newsletter when we broke below in December. That currently sits at about 47,000. That's a confluence of several items. So first of all, the 180-week exponential whole moving average. So this is basically a moving average that has a bit more weighting to the recent price action. So it's a bit more dynamic than just a traditional moving average. I like it a lot, especially for Bitcoin. You could use it on almost all time frames, but I like using it on the daily, the weekly, and the monthly. So the weekly currently sits at 47,000. Short-term holder realized price. That's not anything new that I mentioned in the newsletter. That's that same area. I think it's at 46,900 to be exact. The 200-day sitting right around there. The 2022 yearly open. So I think that's kind of an area where I'd be looking to buy strength if it was shown, and then setting validation right below that. And I think that offers an easy setup where you say, okay, well, momentum's shown back in the market, I'll step in. If it breaks back below, then so be it, right? And so we got something similar to that about a month or two ago when we had that push back up to 47K. It was I believe at the end of March when we had that kind of fake out rally, bear market rally. When we had that kind of fake out of that range that we had been ranging for like 2 or 3 months, and we had the fake out to the top of that. That was a failed underside retest of short-term holder realized price. I think we pushed about $50 or $100 above that. And that would have been an easy invalidation trade where you buy the reclaim of short-term holder realized price and set the invalidation on the big back below. So that's where I'm looking from a momentum standpoint. For some reason I can't talk right now. And then from a value standpoint, I'd be looking to buy low to mid 20Ks. So this is a confluence of several things. First of all, the 200-week moving average sits at about 22K. Realized price is about 24,000 right now. And then so going off of that, looking at MVRV, which is a comparison of market cap to realized value. Whenever this oscillator gets into that green zone, meaning price is going below realized price, we're very close to a full reset on that. You can look at also like the Mayer multiple, which is showing the deviation of price from the 200-day moving average, dormancy flow. I mean, a lot of these indicators, I think, to kind of summarize, are in the lower kind of 10%, 10th percentile of like historical trading ranges, which I think, just to be clear, for a lot of people are just dollar cost averaging into BTC. I think this is a tremendous time to do so. If you have a 3-5+ year time horizon for Bitcoin, this is where you kind of want to step up your auto DCA. Now, for people who are looking to kind of capture the cyclical bottom and take risk in trying to attempt to do so, I think looking at some of these items are a good kind of proxy where I would be looking to allocate capital personally. So I have bids ladder down from realized price to the 200 week, which is down from 24 to 22K. So again, looking to be a momentum buyer if theoretically we were able to get back over a lot of those items we talked about at confluence of 47K, and a value buyer in the low 20s. So personally, I've bids ladder down from 24 to 22. I mean, aside from that, I think it's like kind of the high level. Derivatives, nothing too exciting there. Funding's still just kind of been neutral and kind of been flat. Haven't really gotten any real signal out of watching funding over the last few months, really. Geographic premiums are interesting. So this is something I think I posted last week on Twitter. Asia is currently, their trading hours have currently been trading at a premium to the United States and Europe trading hours, which is very interesting because Asia has kind of dominated this market by looking at trading hours over the last 2 years. They bought the COVID bottom, sold all the way into the early 2021 top. They bought back at the summer lows on the initial kind of liquidation cascade down to 30K. They sold back into that initial pump off of the lows over summer, bought back the retest of 40K, and then sold back in late November into December. And again, I'm using the premiums of trading hours to say this. They bought back at the beginning of January and then sold back into the top of the range that we were in for several months until we had that fake out to 47, as I mentioned a second ago. Recently, that geographical premium of trading hours has gotten to the highest it's been since the summer of last year. So very interesting to note. Relatively high hit rate on the Asian trading hours. Still, could have a bit to go to get up to that threshold of how high it got of summer of last year. But it is something that I find notable that, it seems like Asia's kind of been buying the puke from Europe and the United States, so to speak, which has caught my eye. And then aside from that, some of the stuff we've been banging on drum for month or two is the amount of supply that hasn't moved in at least a year is just continuing to push to all-time highs, which I think is pretty incredible. I think some of that is likely, you have custodial products, but also, I think it is a reflection to an extent of people just, holding their BTC with conviction in this time of uncertainty. We've only gotten up to this like 63, 64% threshold 3 other times. One was at the end of the 2015 bear market heading into 2016. The other was at the bottom of the 2018 bear market. The third was heading into the 2020 initial push up to the bull run in about September, October before that rolled over. And then now over the last month, we've reached new all-time highs in terms of the amount of supply that hasn't moved in at least a year. So that's kind of to summarize a lot of the interesting stuff I've been watching, on chain. But aside from that, really just I personally, aside from those thresholds I described, have been watching macro and keeping very close eye on everything that Warren described. And Blake's section in the newsletter has been real signal over the last 2-3 months. So if you are watching the newsletter, now more than ever you need to be paying a very close attention to Blake's section. So.
Hey, Will, before we move over to you, so you've got an exciting research report coming out about adoption. You want to give a little preview or say any words about that? I think
Sure.
it's kind of, fire away.
I mean, I guess to add a little light and tone to everything we've been talking about. I almost forgot to mention that. So over the last, 2 months, the research team's been working on a user adoption report, which we're using on-chain data to kind of track the user growth of Bitcoin over time and where that's headed relative to other historical technological adoption curves. So I'm really excited to share this with the community. I think it'll be a little beacon, I guess, in the this time of darkness for a lot of people and uncertainty. And so I'm like super stoked to share it. I think there is a pricing model within it. Now it's not co-integrated or claimed to be co-integrated like a stock to flow, for example. I think it's a lot more just high level for very long term kind of market participants. But the meat and potatoes is really the user adoption piece. That's kind of the main section. There's again the price model at the end of it. But what I think is really exciting about the model is it shows us in the report in general, not just the final model, but the report just walks us through how early we really are. And like I will say, until I did this report, I've been spending a lot of time on like short term price action. I write a weekly newsletter with these guys, but it's been really cool for the last month or two working on this to just zoom out and see the broader picture, and to just get a reminder of how early we really are. In 10 years. Bitcoin's network effects are going to take this thing much higher, and that's just in my mind. I'm extremely highly convicted of that, and I think we're in the ballpark of around just shy of 1% of global adoption using BTC, and of course I'll describe what I'm defining users as and how I'm coming to those conclusions. Don't want to spill too many beans, but again, I think we haven't even really hit that main S curve of adoption yet, and I think maybe seeing that in the report will get a lot of people a reminder of what a generational opportunity we have to watch this asset monetize in real time over the next 2-3 decades.
Super psyched, man. Yeah, we're all excited to see that release. So good stuff. Before we move into mining, I Warren, would love to hear your thoughts on kind of just like general energy landscape, right? As you look at energy markets, and part of this, just to preface this and why it's relevant to mining. I mean, as you look at mining, you basically have hardware, and then your 90% of the cost plus are the cost of power, right? So
Yeah.
I'll just I'll drop it right there. Right? Exactly. Fire away, man. Like there's energy so much going on in that world. I'd love to hear your thoughts.
Buy an electron of utility power and turning it into a Bitcoin, right?
Hell yeah.
And I think this is incredibly important, especially for everybody who wants to start mining, who's or maybe hasn't started yet, or who's watching it, is that, everybody makes a big deal about finding the low cost of power, which they absolutely should do. However, there's deregulated and regulated states in the US that have far different, kind of like power schemes. And even in those that seemingly have like fixed cost, if you don't have like a contract right now for power, you're in for a big surprise next year. Most of the utilities in the United States, they're running their financial model purchasing natural gas at $3 or $4. Well, it's at over $7 now. They were buying, nuclear power at a set rate that's, completely blown out. They've been buying coal maybe at, all of these commodities have gotten precipitously more expensive and have, continued to trend up. And with all these macro shocks, have got more and more expensive. If you're not, mining right now with a trusted, partner that has, solid facilities with solid energy contracts, it's going to be very tough, and it's going to cause a lot of disruption in a lot of places in the U.S. But, this singular mantra of inflation about how it hits energy, affects everybody, right? Your air conditioning bills are going to be really expensive this summer. It's, was expensive to heat your home this winter, and in Bitcoin mining, it could really change the landscape. And what that means to me is that it's going to be more, for some entrants, people who are not maybe mining with us or mining at some site with super cheap power, right? The network is going to become much more expensive, so it'll be much more competitive. So prices should then gravitate higher. You can't have one inflationary input and then have a deflationary output, if that makes sense to everybody. We can't have all the costs going into something going up, which it is everywhere, fact, and then have the output going down, having Bitcoin be worth less. But, that is another driver of this that I see as, a big theme for the rest of this year and definitely into next year.
Yeah, no, that's great, Warren. And to put it in frame of reference, like we've talked on these spaces, we try to educate, right? And we try to just share insights. And we've talked about the concept of, counterpart, or just more risk broadly. And then counterparty risk. Last time we got into the concept of, if you're using a service to mine, you've got counterparty risk. If the service is shopping out their obligation, you've got compounded counterparty risk, right? So as you think about, then we talked about like geopolitical risk, right? And last session we talked, that was when, Russia sanctions were happening. That was top of mind. It's like, all right, well, yes, you can get 5-6 cent per kilowatt hour, hosting at power cost, energy cost, in exchange for taking on more geopolitical risk in Russia, for example.
Did that work out well, by the way?
As far as I've heard, probably not. I'll just leave it there. Thank you, Warren. So, as we think about, I kind of think that, this is more of a foresight thought almost, but as we look at mining operations, I mean, just the pressure on the domestic, the U.S., North America, but, largely also the U.S. based, hosting infrastructure from a Bitcoin mining perspective, like, years ago, as a byproduct of lower power costs, there was 4, 5, 6 cent power readily available. And then as you look at, regulated or deregulated states, you've got, different amount of risk that you take on based on, long-term power agreements and so on and so forth. So, I mean, do you see, Warren, like what, as you look at, you're a miner, right? I mean, as you look at acceptable risk parameters and you look at some of these markets, I mean, where do you want to be? Where do you want to be thinking about from a regulated jurisdiction to deregulated? And if you're looking at, risks of, where are the risks? Let's say energy power prices keep rocking higher. I mean, how do you think about that? How do you approach that as to where you want to place your bets? We covered last time, you don't want to place your bet in Russia because there's too much risk. Right now, let's extrapolate down to kind of a power landscape.
Yeah, totally. Right. And, as you said, the first, the thing you think about is where, geographically, right? So we solve that. We don't want to be in, communist Russia appropriating your hardware, that you work so hard to buy. You want to be in the U.S., stable jurisdiction, English law, very good courts of litigation. Second, you want to pick very carefully about the states in which you mine, right? There is a lot of cheap power in New York State. Well, there's also a lot of, regulation that's not very crypto friendly. States like Kentucky, superlative crypto regulation, gone out of their way to welcome miners, extremely good incentives, but at the same time matching with the good that miners are doing in communities that have suffered from the decline of coal. States like West Virginia, getting behind it as well. You look at Wyoming, you look at Ohio, states like this that are really going forward to to really support the ecosystem. So, the power rate is one thing, security access another thing, but that legislative, a body is very important as well. Texas, very close to my heart. I mean, that's my home. But you know what? In my personal view, it's a closed grid, right? And it's a closed grid in a time of extremely high, commodity prices, and it's prone to a lot of shocks. And so I think you just have to balance that because it's also a crypto-friendly legislation. I definitely would count it out. I think it's a great place to be. But I put a lot of thought into exactly where it is. There's so many other things. Getting granular, though. Different tax structures. Like it or not, you're going to be exposed to taxes at the state and local level, which get passed on to the individual miner. And so, being careful where you are is going to reduce your liabilities, increase your profits from this. And that's kind of at Blockware what we do a really good job at. We put ourselves in the most, politically friendly environments with also the best power prices that have, grid and network stability because they're relying on such huge power grids that are not closed loop that we can offer our customers, an excellent amount of uptime.
Yeah, man, makes sense. I mean, I like how you put that in kind of domestic geopolitical landscape almost, right? Like we've been thinking about this on a global basis where, now it's very easy to say like, Russia, Kazakhstan, other countries where I think you so eloquently put it, like, do you want to do business in a place where, they can lock you up and throw away the key? And I mean, like,
hey,
I don't know.
for your
That's
miners.
your decision.
Yeah, I changed my email address.
Exactly. But and as you think about that now, even on a domestic level, like because of the sovereign power of states, really, right? Like, you actually domestically, the United States is not the same apples to apples on a state by state basis. I mean, you have varying levels of geopolitical risk as you look state to state, right? And then they all have different grids. They've got different ways they regulate power. So I think it's interesting. I mean, let's kind of put that one. I'd love to follow up on that on the next month and just kind of see where power prices are at. Looking state by state, and we can go deeper into this as it continues to evolve. That's probably a good transition to our last topic, which is mining. So just to kind of recap a little bit, I mean, basically everything is dovetailing from a macro perspective right now. And Warren covered topics, inflation, just the fact that Bitcoin is basically trading as a risk-on asset that moved right into Blake's segment on the equity landscape, and specifically the way that like publicly traded Bitcoin miners, for example, are really getting kind of punished out there, as a byproduct. And then Will's analysis on the network, just the Bitcoin centric market in and of itself. Now, Tanner, let's go to you, and I'll kind of jam on this with you here from a mining perspective. And actually, I see looks like Mason's on too. So Mason, we'd love to get some of your thoughts on this. But Tanner, why don't you kick it off, like from a mining perspective? Obviously prices down, difficulties generally trending up. Like, what are you seeing? And then, let's open up the can of worms here.
Yeah, totally. So, like you said, price is down, market is trading down across the board. So with that, there's really two key impacts for miners. The first is obviously yield as far as, dollar terms. Bitcoin trades down, the value of what you mine goes down. But for people who are mining strictly for Bitcoin and aren't worried about the dollar, it's more about what the difficulty does. So difficulty just readjusted. It actually went down 4.3% in this latest shift. But in the long term, it's still trending upwards. And while historically prices outpace difficulty, in this shorter time horizon, we've been trading relatively sideways and down since the start of the year, and difficulty has continued marching forward. So with that, the yield per miner is decreasing. But at the same time, when price trades down like this and difficulty is relatively unchanged, it causes margins to get compressed. So as margins get compressed, it's relatively top down. So miners, the least efficient miners, whether they're running old equipment or using expensive power, they're going to be the first to capitulate. So we've already started to see that the cost of miners is decreasing. It hasn't broken through to where it was last summer with the China ban, where people were actually selling rigs, below OEM pricing, but we're getting relatively close to that point. So for people that are mining already, as long as you're in a stable spot where you're not worried about power costs going up and you're locked in, you can weather the storm. But for people that are in mining at their house or somewhere where power cost is expensive, they're starting to approach a point where they unplug. So going off that, if you're mining already, it's a great time to pick up more rigs, because if you're a miner, you're the most bullish participant in the market. You're effectively placing a giant call option on Bitcoin, because not only are you hoping Bitcoin goes up so the value of the Bitcoin you mined increases, but you're also going to face an increase in the underlying value, which is really the hardware itself. It's relatively similar to investing in real estate. People invest in a rental property because they know they're going to get cash flow, and then over time they're hoping for the real estate market to keep trending upwards so they can eventually exit the property. If you're bearish on the real estate market, it's probably not the right investment for you. But if you're bullish, it's the right play. So that's we're seeing a relatively similar approach on the Bitcoin front.
Yeah, man. And I use this analogy, so I apologize to be a redundant broken record for those who are tuning into these a lot. But I mean, for me, the best way to think about Bitcoin miners are dividend paying assets, right? You've got a cost for the asset, a spot value of the asset that is predicated primarily on the price of Bitcoin. I mean, difficulty certainly weighs in, but from a beta-based correlation, there's a strong correlation, especially with latest generation hardware. The more competitive the hardware, the higher the beta correlation to Bitcoin is, right? And then you've got the yield, the dividend in this example, which is the variable yield, which is subject to price and difficulty at any given time, right? So you have this landscape where yield is down, right, as a byproduct of increased difficulty, consistently upticking difficulty, and negative price action, or sideways, but mostly negative right now. So as a byproduct of this, and then even to reel in, like, as you look at public miners, you see these huge orders they do, public information, right? So you compound that with a stressed domestic infrastructure landscape, AKA miners that don't have a home, plus public companies and private companies, right? Not to pick on any public miners, facing a position where they've got over inventory and they need to raise some cash because the product that they're creating, so to speak, is decreasing in value. All these factors lead to basically significantly decreased costs for hardware assets, right? Bitcoin miners, which is the asset in that dividend paying asset analogy, right? So I mean, are you seeing this? Because I'm kind of zooming out on this, Tanner, and just looking at it from a higher level, where it's like, at the end of the day, mining is a kind of a long game. You're not trading mining, so to speak. I mean, we've got liquidity products and so on and so forth, and we can certainly talk more about that to get asset-based liquidity. But I mean, we're getting to the point where miners are low, and I'm looking at this on a 2, 3, 4, 5 year ROI investment, and now the asset side, the capex side of this equation is significantly down. I mean, you've got personally a lot of exposure to different kind of demographics of purchasers, right, from retail to very sophisticated, so to speak, institutional capital. How's that playing out, right? I mean, like, bottom line, hardware pricing is down. What is that looking like from a market reaction perspective? And I see Warren or Mason on. Mason, Tanner, hit this first, and let's see what Mason has to say about it.
Yeah, so I mean, it's blood in the streets, right? People who have been mining or are overall, bullish on the long term are happy to see rig prices go down. All they're doing is averaging their basis by scooping up all these low cost miners. It's relatively similar to last summer. We saw the almost same scenario play out, not at the same scale. It was much larger, but people that don't have their plan in place, whether it's short-term power agreements and they're worried in a year all of a sudden their power cost is going to get jacked up, or have no home and are running miners in their basement at 20 cents a kilowatt hour. Those people are starting to puke up their rigs, but at the same time you can see that nobody's going below OEM pricing. So there's still potential room, but at the same time it's a bullish signal because they want to unplug and potentially get some cash back, but we haven't hit a point where people are truly giving away equipment.
Yeah, and just to add, I've got a few different perspectives. I think we saw a race of saturation in the public markets. Anyone and everybody from the power plant side to reverse mergers of prospective mining companies into power plants, from miners who were small, raising a lot of capital into this space. Having come through pretty much every deck of any company that was trying to go public, there's usually a few flaws in those decks. Not to name names, but some of these companies did exceptionally well. But I think if you look at the macro from a stock performance perspective, I wouldn't say that any of these companies have outperformed. I think why we're seeing some capitulation right now is a lot of these entities that raised a lot of capital, several hundred millions of dollars, that do not have hosting infrastructure, and the partners that they selected or the power plants they were going to deploy at did not foresee delays that took place. And what we're seeing across the board is it's extremely hard to find the electrical infrastructure that's required to deploy at scale. Even if you're a power plant, you need to find transformers, you need to find switch gears, you need to find PDUs, you need to find power cords. If you're missing any of these individual components, then you're in trouble. And even if your power cords are 6 weeks delayed and you have everything else, then you're 6 weeks delayed. And for these companies that are, and have placed, hundreds of millions of dollars worth of mining rig orders that are receiving mining rigs, they're just starting to stack up. And if you really analyze some of the public companies and some of that are going public, you'll see that the hash power that they should have is far off than what they actually do have. And there was a metric that I really analyzed in my early days when I saw this saturation taking place. It was an analyzation of future dollar per petahash value. So you can measure a company based on the current dollar per petahash and how much you're paying per dollar of petahash. And then you can measure the future dollar per petahash value based on the order books and the order flow that they had. And I just consistently have seen such a large variance between those two. And then combining that with analyzing revenue, what you're finding is that these companies just have stagnant machines. And that's, I think, why we're seeing some capitulation on the mining rig side. During sideways markets and bear markets, I think it's actually the best time to build and mine. The largest companies and the most saturated and those that have raised the most capital and have the best energy costs have break-even costs of Bitcoin, sub 10K, right? So this is just a day in the life of why you mine Bitcoin, because every single day you're purchasing Bitcoin at a cost basis of $10,000. In theory, if operations are going as as planned. But for those that promised something and partnered with the wrong partner, they're in trouble. That's why I think what you'll see is an emergence of vertically integrated companies outperforming. Those that really control the full stack. And the full stack can be defined in several different ways, but I think you have to be the source of your own machines, the owner operator of your own data centers, the source of your own electrical infrastructure, the source of your own software, the source of your own pool, the source of your own research, the source of your own analytics as it ties to that research, the source of your own forecasts as it pertains to where you believe the network's heading and your profitability as it relates to your future mining rewards. From a game theory perspective, the way I see the next 10 years, I think it's going to be some of the best mining and the best macro market for Bitcoin of all time. 90% of Bitcoin has been mined to date. Out of the 100% remaining, 7% of the supply is going to be released over the next 10 years. Game theory says deploy now, and you saw a lot of Wall Street and greed chase companies that raised hundreds of millions of dollars that really didn't have their project plan, nor infrastructure, nor business strategy mapped out the way that it looked so in their deck. And there's a lot of different reasons why, some of these miner manufacturers really didn't deliver. I like to stick to just ordering from Bitmain and MarketBT at the moment. There's nothing more that I'd love to see than a US-based miner manufacturer, but we're not there yet. And from a risk management standpoint, you have to stay within the bounds of trust and what you believe in, especially when you're a client-facing organization like ourselves. Something we've prided ourselves in is becoming the owner-operator side. It wasn't initially in the Blockware roadmap, many years ago, but we diversify and we revolutionize to the marketplace, and we saw a need to control our own destiny. So we invested our own capital. We took on no debt, and we built out facilities in Kentucky. We just signed in a brand new facility in West Virginia. We lobbied for these facilities. We worked with the House and the Senate and the governors to find favorable terms. And this, reverts back to something Warren was talking about. Political jurisdiction is extremely important. I always say you need the perfect cocktail of many different elements of mining to have a successful operation. I put energy costs and politics as very close number one and number 1.5. And then I can name, number 2 through 8 of different spectrums. But a lot of the public miners right now, if you look at their balance sheets, they have a lot of debt. And some of those that are vertically integrated will do just fine. Many of them bought machines when they were cheaply priced, and they'll be in a good place if they need to capitulate. But for the new entries, the pressure's on, right? They signed unfavorable interest rates and debt collateralization, and the investors are going to be knocking at their door. So their way of meeting demands of paying off their interest is selling off their rigs. That's why we're seeing, a general cheaper price in rigs. It's been a little different from what I'm used to seeing as far as Bitcoin price action compared to rig price action. Rigs have kind of gone down while Bitcoin's traded fairly close to 30K over the last 2 weeks. And that's, I think, because of what I'm mentioning to you. So the market, sentiment overall, I think, is extremely bullish. And I have really high conviction that we're in for some fun times. I think a lot of people are learning about themselves, and especially in the larger players market, right? Those that raise a lot of capital and figuring out, what their destiny is. And to the point of, who's going to make it in the mining market, it's the guys that know what they're doing, that are vertically integrated, that understand the market and have a very good roadmap and can execute. It's all about execution in the end. Anyone can pitch you a VC deck that's 45 slides about the team and what they're going to do and raise hundreds of millions of dollars. Well, not anyone can do that. I retract that. But it's the guys that actually go execute and make their investors successful. So that's the end of my little mining rant. And,
no, Mason, that was awesome, man. I mean, one thing I want to double tap on one thing there and just kind of unpack, one thing real quick, because you talked a lot about vertical integration, right? And you also talked a lot about how difficult it is, really. I mean, let's think about this. To mine Bitcoin at scale. You need friendly geopolitical jurisdiction, right? You need hardware. You need, which is, basically concentrated in, a couple, I think it's fair to say a couple, manufacturers in China. The business practices are a little opaque, just on a national basis. It's not an easy landscape to navigate. You need cheap, but not just cheap. You need reliable, consistent power, right? Because cheap power that gets blown out, that turns into expensive power, means a lot of people are getting wrecked, right? So you need all these things, and you need software, and you need a pool, right? So as you piecemeal all these things, and as you lose control, I'm just total risk mitigation man over here. But you need, if you shop out your obligation to fulfill all of those, very challenging things in a very challenging landscape, like supply chain is very challenging right now. The energy markets are very challenging right now. Getting hardware, as a byproduct of supply chain, very challenging. Software is always going to be, moderately challenging to some degree, right? So I kind of take what you just said, and as I unpack that a little bit, what vertical integration is a nice term to toss around, but what it really means is that you control your destiny. And if it was so easy, everybody would do that, because if you ask anybody that isn't just bullshitting you, if you'd rather be in control or out of control, very simple question. People are going to say, I'd rather be in control, right? But what if being in control cost you, $10 or $10 million or $100 million or $1 billion, right? There's a level where you just can't accept control on that. So as we talk about vertical integration, it is easy in a raging bull market with a shitload of demand and everything goes up, stonk life, to just take on that risk, because you're probably going to be okay based on, primarily macro factors, right? And now we're in a challenging macro environment, and this is where your mettle is tested, right? So, not to just be on a soapbox here, but I think when you talk about vertical integration, that is key, is being able to control your destiny to the extent that you've sufficiently mitigated risk for yourself and your stakeholders, right? And your customers, depending on this. For our business model, we have a fiduciary responsibility to mitigate risk to a, very reasonable degree for our stakeholders who are our customers, right? So, I do think, I totally agree with you. I think that is going to be a winning recipe over the long term. And you can't thrive if you can't survive, right? So this is survival time. And this is going to be, I think, an interesting to see this all play out over the next, the rest of the year, right? We'll check back in and see who got blown out, right? Where equities are trading from a public miner perspective. All these different things are going to be catalysts for, who's entrenched well enough to survive the shitty times so they can thrive in the golden times, right? So we've covered a lot of topics. We've went longer than we typically do. Kind of tossing around Will, Mason, Tanner, Blake, Warren. Anything else you guys want to add? Any other topics? Otherwise, probably wrap it up here.
This is fantastic. I think this is the longest we've ever gone on any of these after the, I want to say 5 or 6 months that we've been doing them. So, Mason, it was good to have you up here, man, and thanks for everybody for tuning in. Really appreciate you taking the time to listen to everything we have to say, and hope you got some value out of this.
Yeah, no, thanks everyone for hopping on. We've got really exciting research report coming out. We're also releasing some new software that we built on Lightning. Stay tuned on that. It's really exciting times for Bitcoin and mining and macro. I think it's painting a picture that there's more adoption, more evangelization. The institutions are here. There's products and debt and other types of services that didn't exist before that are now here. I don't look at price. I really don't look at Bitcoin price on a daily basis. It would drive you crazy. Will does that more than I do. I look at the bigger picture in the future, and I couldn't be more bullish.
Right on. All right. Thanks, everybody. Have a good night or morning or day. Cheers.
Thanks, everybody.
Peace out.
Take care, everyone.